In this video, I will show you on how to prepare a short-term financial plan or the budget preparation. Short-term financial plan involves forecasting the financing requirements of a business within a year or less. This financing requirement comes in the form of cash. Contrast this one with the financing requirement from a long-term financial plan. Cash budget, also known as cash forecast, is a primary tool in short-term financial planning. It plots the business projected cash inflow and outflow and is typically done monthly and is used to cover a year's time. It is used by the firm to estimate its short-term cash requirements with particular attention being paid to planning for supplies and for cash shortages. Budget preparation is a planning and control tool often utilized by most decision makers. This is an example of a cash budget. It is divided into three parts, which are the cash receipts, cash disbursements, and the required total financing or the excess cash balance. Steps in preparing cash budget. Number 1. Forecast the business monthly sales. Again, this can be done using historical figures. Number 2. Forecast the cash sales and the credit sales from the projected monthly sales. Cash sales are more preferable to credit sales. If sales are made on credit, then estimate when those receivables will be collected. Number 3. Take into account other cash receipts. Other cash receipts are sources of cash other than sales, such as interest payment received. And the number 4, sum up the total cash receipts. Let's now prepare the cash receipt schedule following steps 1 to 4. You have to forecast the business monthly sales. You have to you have to remember that January and February cash receipt schedule is already posted or meaning these are the given in this situation. And we are going to prepare a cash receipt schedule for the month of March, April, and May. Now, sales for the month of March, April, and May have been forecasted. And thus, we're trying to develop a cash budget for March, April, and May. Next, based on historical data, 15% of the business sales are in cash form. So we will get the 15% of our projected sales per month. So that's how we get the 57,000 for the month of March because the projected sales for the month of March is 380,000 and then you'll get 15% of it. So the same process for the month of April and May to get the cash sales. Next, the 55% of the forecasted sales will be collected after 1 month. So we have an accounts receivable collections lag 1 month, and that's 55% of January sales. So the same process for the month of March. The 121,000 is the forecasted sales. It's the 55% of the forecasted sales for the month of February, and so on and so forth. Then, to get the 30% or the rest of the percentage of the projected sales for the month of January, we'll be able to collect it after 2 months. That's why from this example, we got 45,000 because that's the 30% of 150,000 from the month of January. So for the month of April, we got 66,000 because that is 220,000. That's the 30% of 220,000 sales of February. And February, or from February, you count 2 months. So we got May. That's April. That's why it's posted for the month of April. So it's the same for March and May. Next, we have to take into account other cash receipts. The company also receives a monthly interest payment of 150,000 from a bank certificate deposit. That's why we have other cash receipts worth 150,000, and that is posted monthly. Then step number 4, for us to get the total cash receipts, we have to get the sum total, or we have to sum up everything. And then for the month of March, we'll get 373,000. Okay, in getting the total cash receipts, we will only add up from cash sales up to other cash receipts in order for us to get the correct figure for total cash receipts. So all you have to do is to follow the same step for the month of April and for the month of May. To continue in preparing the cash budget, we have to prepare the cash disbursement table or form. So the fifth step is to forecast the business monthly purchases. Number 6, forecast the cash purchases and the credit purchases from the projected monthly purchase. If purchases are made on credit, then forecast when those payables will be paid. Number 7, we have to take into account other cash disbursements. Other cash disbursements include wages and salaries, taxes, capital expenditures, rent, and interest payments. For step 8, sum up the total cash disbursements. Let us now try to prepare a cash disbursement following steps 5 to 8. First is forecast the business monthly purchases. Purchases in January and February were 120,000 and 176,000 respectively, meaning it represents 80% of sales. So January and February purchases are 80% of sales. So purchases from March to May will be 80% of sales as well. So we have to go back to our cash receipt schedule to get the figure of to get the 80% of sales. So for January, 150,000, then 80% of 150,000 is 120,000. For February, and then for March, April, and for May. Next, forecast the cash purchases and the credit purchases from the projected monthly purchase. Based on historical data, 5% is paid in cash. So, we'll get the 5% of or to get the cash purchases, that's 5% of the total purchases. So, in this example, 120,000 times 0.05 or 5%, then you'll get 6,000. So, 6,000 is the 5% cash purchases. So, the same process for February, March, and April, and May. 80% and 15% are accounts payable and will be paid after a month and 2 months. So it's almost the same with cash receipt schedule, but this time this is accounts payable, and cash receipt schedule, that's accounts receivable. Now we have accounts payable payment that will be paid after 1 month. So for January, we will pay the 80% of it, or 80% of our liabilities, of the rest of 80% of our purchases to February, or on the month of February. So 96,000 is the 80% of the purchases from the month of January, which is 120,000. And then 140,000 and 800 is the 80% of our February purchases, and so on and so forth. Now, the remaining percent, which is the 15%, will be paid after 2 months. So we'll get the 15% of our January purchases, and then it will be posted after 2 months, which is for the month of March. That's why, as you can see here, 120,000, and then multiply it to 15%, you'll get 18%, meaning we're going to pay the remaining purchases, which is 18 worth of 18,000 for the month of March. So the 26,400 here that is posted in the month of April, that is the 15% of purchases from the month of February. So for the month of May, that is the purchases from the month of March. Next, uh, we have to take into account other cash disbursement. So, the business pays a monthly rent of 15,000. That's why 15,000 will be posted on each month. Wages are 5% of monthly sales, and on the other hand, the fixed salary cost for the whole year is 144,000 or 12,000 per month. Again, wages are 5% of monthly sales. So we have to go back to our cash receipt schedule to get the figure of our sales, and then you'll get the 5% of it plus the 12,000 monthly, and that's how we got this figure. The business will be paying taxes of 40,000 in April. The business also invests in a new machine worth 200,000 that will be paid in full in March. Furthermore, an interest payment of 110,000 is due every month. So we have to post 110,000 monthly. And then a 150,000 principal amount payment is also due in May. Now, to complete the process, sum everything up with the total cash disbursements. So, the same process in getting the total cash receipts. We have to get the total from cash purchases to other purchases or to other cash disbursements. So, we'll get 530,000 for the month of March. So, the same process for the months of April and May. The last part of preparing the cash budget is to identify if you'll have an excess cash balance or you'll have a required total financing. So the step number 9 is to subtract the total cash disbursements from the total cash receipts to get the net cash flow. Next, add the beginning cash balance to the net cash flow to get the ending balance. The ending balance or the ending cash balance of the previous month is the beginning cash balance of the following month. Okay, and then last, subtract the minimum cash balance from the ending cash balance. And now, we are ready to prepare the cash budget. We use steps 9 to 11 to do this. So we have to get the cash receipts first or the total cash receipts from our cash receipt schedule and our cash disbursements from the total cash disbursements from our cash disbursement table or schedule. And then we have to remember that January and February are transactions that are already done, or meaning we are now trying to make a cash budget for March, April, and May. Now, we have to take into account the target cash balance of 90,000 and the ending cash balance in February. So, the next thing that we will do is to subtract cash disbursements from cash receipts to get the net cash flow. So, for the month of March, our cash receipts is 373,000 less cash disbursements of 530,000, and then we'll get a negative 150,000. And then we have to we have to add the beginning cash balance, or where are we going to get the beginning cash balance? The beginning cash balance is the ending cash balance of the previous month, which is February. Again, the ending cash balance for the month of February, which is 70,000 pesos, will now become the beginning cash for the following month, which is for the month of March. So, you'll be able to see 70,000 in the beginning cash balance for the month of March, because that is the ending cash balance in the previous month, from the previous month, which is February. So meaning the ending cash balance for the month of March, which is negative 87,000, will become the beginning cash balance for the following month, which is April. Now, to get the ending cash balance, it will be, you have to add the net cash flow and the beginning cash balance. So the ending cash balance for March is now negative 87,000 less the minimum cash balance amounting to 90,000. But Miss, where did we get the 90,000? Okay, the question is, where did we get the 90,000 minimum cash balance? So from the situation, before we start preparing the cash budget, we were told that we have to take into account the target cash balance of 90,000. When we say target cash balance or minimum cash balance, it is the minimum cash balance the business needs to have on hand to conduct its day-to-day operations. So after deducting the minimum cash balance from your ending cash balance, you'll be able to identify if you'll need if you have a required total financing or excess cash balance. So in this scenario or in this situation, it will be ending cash balance less minimum cash balance. The result is negative 177,000. Result or uh, if the answer to ending cash and then you less the minimum cash balance is negative, you have to post it in the required total financing. But if the answer is positive, then you'll post it in the excess cash balance. Okay, since the result is negative, then the business will have a financing need of negative 177,000. So it's the same with the month of April. We'll need, or there is a required total financing of 178,000, and also for the month of May. So you have to remember that if the minimum cash balance is greater than the ending cash balance, meaning short-term financing required, or the business will need additional money or additional um, capital or additional cash. While if the minimum cash balance is less than the ending cash balance, then the business will have an excess cash. But how are we going to evaluate the cash budget? If the ending cash balance after payment of all required disbursements is less than the required ending balance, the company needs to borrow additional cash from short-term borrowings to meet its required ending balance. Should the ending cash balance exceed the company's minimum cash requirement the next period, the company may be able to repay the loan plus accrued interest. Should the company have excess cash above its required maintaining cash balance, the company may invest this cash on short-term investments so that it will have an opportunity to earn additional profits. If the company's cash balance would then fall below its minimum cash requirement, the company may withdraw the investment to be able to meet the required cash balance. If you have any questions about the topics discussed, don't hesitate to send me a message. Thank you.